So hello everyone, good evening. Thank you for joining this event of the EAGE Local Chapter Paris, part of the global EAGE. My name is Nawal de Frelon. I am the president of the EAGE Local Chapter Paris. So today we decided to organize this event linked to the actual, to the current sanitary situation that affect all of us. Particularly the speakers who will explore the impact of the COVID-19 outbreak on the upstream oil and gas industry, and so its consequence on different aspects. So that they will develop during their presentation. Okay. So just few updates about the EAGE. First, in 2 weeks, there will be the annual conference online that will be held. So there is a discount that will be offered during a few days, during this weekend. If you want to register, it's still possible. And the second news, so the local chapter Netherlands is organizing an event in December that we'll share with you this information. If you want to register, you can find the link on LinkedIn. Okay, so I will introduce the speakers of the event. So I'll start with Marine Simoën. So Marine is an economist engineer graduate from Chimie Paris and IFP School in France. So she worked on the geopolitical and critically of raw materials in the energy transition context at IFPN for a few years. Then she's an associate research fellow at IRIS on climate, energy, and security questions. And she has recently joined the industry where she is using her expertise to support the transition toward low carbon businesses. And the second speaker that will present jointly with Marine is Pierre Hacquard, analyst and petroleum geoscientist. So Pierre is a petroleum geoscientist and analyst graduated from ENSG Nancy and IFP School. He has been working for different actors of the oil and gas industry, including research centers, service providers, and financing entities, where he has developed a deep understanding of the challenges that it is facing. He has recently joined a major where he is supporting exploration and operations in the North Sea. So few ground rules before the presentation. So you are currently all muted with video off by default. So please keep it like that so we don't slow the network. There will be presentation after the question after the presentation, but also during. So you will see in the chat, you will be asked for questions and you will be able to write them, and then they will be read. So we are gathered together for the pleasure of sharing and learning. Thank you Pierre and Marine, and enjoy the presentation. I leave you the floor.
Thank you, Nawal. I will share my screen now. Okay, do you see my screen now?
Yes.
Yes.
You can put it full screen.
Yes.
Okay. So thank you, Nawal, and thank you, the EAGE, for giving us the opportunity to have this session tonight. So what we are going to talk about is the upstream oil and gas industry and the current risk regarding the supply and also the potential impact of the COVID-19. And to give you a bit of context, we already did a study last year. Pierre, if you move to the next slide. A study where we asked ourselves if the industry was able to support a world that consumes 105 million barrels of oil per day in 2025. And we concluded that at the current pace of investment and demand, we could fear a potential oil crunch in the coming years. So the idea today is to give you the main risk we highlighted in the study and also to put them in the perspective of the COVID-19 so that you could have in mind most of the points we think are important to better understand the future trends on the oil supply. If we look at the plan, I will just briefly introduce the key figures on the COVID-19, and then Pierre will share perspective on the exploration and investment in the upstream sector with a zoom on the US onshore. Then I think we can have a Q&A session about 15 minutes. And then I will present some perspective on geopolitics and climate, and also regarding the demand before concluding. So if we start very briefly with the COVID-19 pandemic, you know that it has started to spread in the world since March 2020. So it has led to several lockdowns in the world and a massive collapse in the oil demand, resulting in an average drop of the demand by 9% in 2020. But also leading to a global recession, minus 5% of economic growth in 2020, and is the worst recession since the last war. So if we move to the next slide, another consequence of the COVID-19 has also been a massive collapse in the oil prices due to many different factors. The price have stabilized for a few months now, thanks to the OPEC agreements and the cut on the production. And recently also with the announcement on your new vaccine, it's almost $50 the barrels. So that is really just the big context that you have to keep in mind during this presentation with the COVID-19. So the collapse in the oil demand, the collapse in the oil prices earlier this year, and also a lasting massive recession. And having said that, I give the floor to Pierre to give perspective on the upstream oil and gas industry.
Thank you, Marine, for the introduction. So in the next minutes, I will try to deep dive into the hot topic of today, and I will try to talk about the different trends that we can see from the different sources and data we have gathered in the exploration, but also in the investments when it comes to oil production. And I will try to focus on showing you both historical data and post-COVID data so that you can yourself assess how the industry reacted in the previous crisis and also compare it to today's situation. So most of you have probably already seen this kind of modelization, but I think if you have to remember one graph from all the presentation, it's probably that one. Because before to talk about the impacts of the COVID on the industry and the future of the supply, it's really important to have in mind the structural challenges that the industry is facing today. So we are consuming around 100 million barrels per day on average in 2019 before the COVID. And you must probably know that most of the production today has reached already the plateau and is in decline phase. So when you reach the decline phase, the estimation are that we are losing around 8% of production on average per year. And if we continue to invest in existing field, we can divide by 2 this rate of decline to 4%. But if you compare the decline to the current forecast in demand, even in sustainable demand scenarios or in stated policies demand scenarios from the International Energy Agency, what you can see is that by 2030, we will have to put on production the equivalent of 4 Saudi Arabia, and by 2040, it will be up to 8 Saudi Arabia. So this is a massive challenge that is awaiting the oil industry, because everyone that has been involved a bit knows that we are far from being able to put those numbers into the market really easily. So the question we can ask ourselves is, where will this production come from? From the conventionals, from the unconventionals? I'll try to answer some of and give you some answers in the next slide. So, well, we must not count on new conventional discoveries because we are not finding conventional oil anymore. What you can see here is a graph, historical graph showing the oil discoveries in millions of barrels since 1950 up to 2020. And what you can see is that we have passed a peak in the 60s, 70s. And after this peak, we have steadily declined on average. And the last 5 years has been the lowest on record. 2017 was the lowest since 1933. And in red, what you can see is the total liquid consumption in 2019. So we are consuming around 36 billion barrel of oil per year. And with the current rate of discovery, we have a replacement rate of the reserve less than 10%. So basically, we are living on past discoveries. It can easily be explained because we have already defined all the big fields, and there are less and less frontier areas that are available, and they all present high geological, political, but also commercial risk. So more and more exploration strategies focus on mature and prolific basins where the rewards are lower, but as well are the risk. And it's also a strategy that fits much better with the energy transition storyline, because it's much easier to explain that we want to explore less than we are discovering less. Another point that we have to keep in mind is that every crisis since 2008 has affected a lot the exploration side of the upstream, because it's the one that is the riskiest and that generates return on the mid and long term. If we look at the number of exploration wells that have been drilled over the last 5 years, you can directly see the impact of COVID-19 in 2020 with less than 600 wells. So it's probably the lowest amount of exploration wells drilled in history. And you can see that since 2016, the level was quite stabilized after the shock of 2014. So this is one of the first consequences of the COVID on the exploration industry. Another point that is worth to mention is that the average size of discoveries is shrinking. And in 2018, the average discovery was able to fill half a day of global liquid consumption. So this is one of the problems that is facing the oil industry today. And it's also creates another physical problem, because the smaller the fields, the faster their production decline. So you can see here a daily trend that we have to put more and more new small fields on the market to compensate the fact that the production will decline even faster. So are we discovering less because we drill less, or are we drilling less because we discover less? We think it's a bit both. And this graph, I really like to show it. It's historical data set up to the 70s, where you see the global number of drilling rigs in the world. And you can see the evolution over time and with the different crises. So just for the colors, the blue here and the blue is the US, and the rest of the world is here. So what you can see when we come to the previous crisis in 2008, the shock was pretty brutal. The US lost 2/3 of their drilling rigs, but it came back to past levels and even above, because it was just a financial crisis, and the fundamentals when it comes to oil supply and demand were the same. 2014 was another story. The shock was really brutal, and we never recovered as an industry to previous levels. What you can also see is that here the COVID-19 20 shock is very, very steep as well, and we have halved the number of drilling rigs in the world since January 2020. And it's also worth to mention that this level is the lowest ever on record. So actually at the moment, we have the least number of drilling rigs active in the world. And you can see that the US have been particularly affected by this shock. So it's impossible to tell if it will pick up or not. But if you look at the past trends, we can reasonably say that it will take at least a year or more to recover fully to past levels. On the investment side, as already mentioned, 2008 didn't alter the fundamentals. Here you can see like this graph showing the global upstream oil capital expenditures since the 2000s. In dark blue, it's like on the brown field, you have the green fields here and exploration. And what you can see that after 2008, the shock was not really on the oil industry, it was more on the global economy, and the investment kept growing until 2014. However, the shock on 2014 was really strong, and the amount of investment that were not made is huge. We estimate it's up to 1 trillion of oil investment that were either cancelled or delayed. And what you can see is that even when the oil price stabilized and recovered to okay levels, the investment didn't pick up. It's worth to mention that adjusted to the new price of putting on production new fields and discoveries, it's less impressive than it is on the graph, because mostly services companies have reduced their costs, which allows the break-even of most of the fields to be lowered by a lot. If we look at the projection after the COVID-19 shock, then we see again a reduction in oil investment. The size in exploration is also shrinking. But what is interesting also is that the first estimation that comes from Wood Mackenzie or Rystad estimate that the levels will not recover as well to what it was before 2019, even if the demand pick up again. So it's quite worrying for the industry and its ability to reach the supply need that we will have in the coming years. Another interesting graph that we wanted to show you is this one. It compares all the investments in the different sectors of the energy system between 2019 and 2020. So what you see is that all the energy sources have been affected by the 2020 COVID-19 shock. But the oil and gas industry is the one that has been the most affected, with a sharp drop of 35%. Compared to the 8% decline in demand, it's a very big shock, and there is other things at stake more than the oil demand shock, and it's probably linked to the energy transition and the perspective of investors when it comes to the future of oil and gas. We also wanted to highlight something which is for us quite important, is that all the crises over the last 20 years have made the industry more resilient. So today, the global producing capabilities of oil supply are around $23 per barrel, according to Rystad. So it's much more lower than what it was in 2014 or 2008. So we expect that this crisis will also drive the cost down and potentially unlock some of the reserves that are here uneconomical at the current barrel prices. Overall, the measures taken to absorb the shock of the COVID crisis were quite brutal, and we feel that the effect will be felt for years. So the first estimation by Rystad mentioned that we have lost approximately 6 million barrels per day by 2025 due to the reduction of production or the lower or delayed investment. So it represents 6% of the global production today. And if you put this in perspective with the first graph on the need for the supply in the future, it could have devastating effects on the equilibrium between the supply and the demand in the coming years. Of course, one of the predictable consequences of the crisis is that we have been through another massive reductions of jobs across the globe in the industry. Rystad estimate that we have lost up to 22% of the global oil and gas workforce in 2020. It does represent approximately 1 million of jobs. So you have probably seen most of the majors like BP, Chevron, or ExxonMobil, as well as the services company, announce a lot of big numbers of layoffs or cutting the recruitments. And as you can see, in red here, you have the amount of jobs that were lost in 2014-2016 crisis. It was about 30% of the oil and gas workforce at the time. So it's another massive blow into the oil and gas skill potential. And what you can also notice is that the shale industry is the one that is hit the hardest, and it's because the oil and gas in the US is probably the most important industry when it comes to the oil and gas globally. So that's why we are going to switch to the US and have a zoom on the US onshore. Over the last 10 years, 60% of the demand increase has been covered by the US unconventional alone. So no one really anticipated this boom, and it has been a true game changer in the industry. It has transformed energy politics, geopolitics, and supply perspective potentially forever. What you can see is that the 2014 crisis didn't add a big shock on the production, even if a lot of people expected the shale industry to collapse because of their high costs and the huge amount of debt already at the time. But they achieved an impressive technological progress and compensated the lower oil environment to be able to produce more. So when we came in 2019, a lot of analysts were thinking that the US onshore could grow above 10 million barrels per day or even reach 15 million barrels per day by 2025. And if you remember the paper that we mentioned in the beginning, one of the things that we noticed is that the International Energy Agency expected the US onshore to produce 15 million barrels per day by 2025 to fill the gap of supply. So what you can see is that the COVID-19 shock here had a huge impact very quick. Everyone has to shut some of their wells because of the lack of storage place. And we lost around 2.7 million barrels per day at the worst. It recovered a bit since, but we are still far from the pre-COVID level. And the first estimation by the EIA, like the American agency, are that we won't recover to past levels in the US shale patch. You can also notice that in 2019, it started to flatten, and I will come back to that a bit later. So I just wanted to mention that, but this is the massive improvement in cost efficiency and productivity done by the US industry. So you can see in blue is the cost per lateral foot of a well in the US. So you can see that it has been steadily declining, and in red is the average drilling length of a well. So basically, like, we have drilled longer wells that have cost cheaper. And for 2020 and 2021, it was expected to continue. So we can expect more innovation, and it's not impossible that the US shale patch will be able to drill and produce lower cost barrels. When we talk about the US onshore and the unconventional production, this graph for me is essential. It shows you the average production per well after the first months of production. So you have the number of months of production here. And basically what you can see is that after the first month of production, we reach a peak, and we then enter exponential decline phase, which achieve by 12 months 70% of reduction of your productivity, and by 24 months 90%. Then you have this kind of tail production that lasts for a long time. So you can notice two important things. First, if you want to be able to increase your production in the US shale patch, either you have to drill exponential new wells to compensate the decline, or you have to increase the productivity. So basically what the US has done, they have increased a lot the productivity, so they have more than tripled the productivity. And you can see that after 2014, there have been a massive increase in average productivity per well. But since 2016, 2017, the increase in productivity started to flatten. So we don't know where the next wells will be, but potentially it will continue to increase because there are still a lot of space for improvement. But it's important to remind that it won't grow forever, and at some point the productivity per well will reach a peak, and it will be the announcement that the potential growth in the US will probably come to an end. What we wanted to show you here as well is the number of horizontal wells that have been drilled in the US since 2000. And you can see exponential rise to around 100,000 wells by 2014. Then you had a break in the number of wells being drilled, because we have reduced basically the number of drilling rig. But what it does mean is that for us, we don't expect the US onshore to reach sky-high levels of production, because they are already structurally on a decline trend in a way. And we see that the COVID-19 has been a catalyst when it comes to stopping this production growth in the future. When it comes to the drilling rig, this zoom on the US historical rig count is quite interesting. So you see two very important things, is that after 2014, the US have basically stopped to drill vertical and deviated wells, and they have drilled around 95% of only horizontal onshore unconventional wells. And what you can see is that after the COVID-19, we have reached the lowest amount of rigs active in the US since the First World War. So this is very worrying when it comes to the supply stability. And I will also talk about where could go the US industry in the future. So all this production growth came at a cost. A massive amount of investment have been made in the past. And what you can see here is the free cash flow from all the different plays of unconventional oil in the US since 2000. And basically what you can see is that even if some of the plays were free cash flow positive around 2013 and until 2019, they didn't compensate the fact that the entire industry at large was losing cash. And the sole year where we had a free cash flow positive was in 2016. And what you can see is that it was really small. So basically, here it's a very important graph when it comes to the potential of unconventionals in general. Like, no one has been making money for the moment and have paid back their investors in the US onshore. Only a few players, like the majors that have selected sweet spots, were able to generate positive cash flow, but it came at a cost for the rest of the industry. You can see also this trend in this graph. This graph mentioned oil and gas, North America and Europe, debt insurance. So basically the amount of debt raised by the oil and gas players. So you can see that it is disproportionately in the US, with more than 600 billions of debt raised, and followed by the United Kingdom, Norway, and Canada. But what you can see is that after 2018, the lenders were started to pull back from the investment in this industry, because they started to see that the returns were not here, and they were focusing on stricter financial returns. So naturally, one of the effects of this crisis as well is a consolidation for survival in the US oil patch. So since the start of the crisis, we have seen some of the most impressive merger and acquisition deal in the US, with Conoco and Chevron making a big acquisition of Concho and Noble. We had full mergers between Powers Energy and Pioneer Natural Resources, etc., etc. And we'll probably see more of this activity in the future, because it's basically a question of survival, because most of the players here were not able to generate enough cash from their production. And if they didn't do that, they will basically end into this graph. And this graph is representing the US E&P bankruptcy filing since 2015. It's a lawyer firm that is making this, this analysis. You can see that cumulated since 2015, the US E&P bankruptcies cumulate $2 trillion of debt, of which $1 trillion is considered unsecured, which means basically that they probably won't be recovered by their lenders. It's massive, and you can see that there is a quick acceleration in 2020 of the amount of debt of the players that are in bankruptcy mode. And you can see that it's $600 billion of debt that is being in bankruptcy just this year. So this is massive. This is almost the debt of France. And this is why we also don't see the US onshore patch recover to such level that it was pre-COVID. So what about global unconventional then? Can the unconventional elsewhere take over and fill this gap of production? So in our paper, we already highlighted some of the parameters that make the unconventional boom so special. So basically, they had access to a quick and large domestic market. They are the first consumer of oil in the world. and they had already a well-developed industry back in 2010, 2012, when they started to develop their boom. They have a high density of infrastructures. They have a very competitive landscape with different players driving down cost and driving innovation. They have a very high talent pool capacity, with a lot of university able to deliver thousands of new students every year, and a lot of professionals that have been around for years. They have very specific mining rights, as you probably know. When you own the land, you own the subsurface. And they had half of the world drilling rigs before the boom started, plus having a very mature and important investment network with abundant financing capabilities. So we might see some production start in Argentina, in China, in Russia, or elsewhere, but it won't be, in our view, to the scale of the US. So I will now let Marine jump on the next part, and we'll before that make a quick break and take question if you have any on this part. Thank you very much.
Thank you, Marine and Pierre, for this very interesting presentation so far. Yes, we have a few questions. When the economy will restart post-COVID, how will the oil and gas supply be able to cope with demand given the years of low capex investment? What are your thoughts?
Do you want me to take this one, Marine?
I think what we are trying to give you during this presentation is exactly all the different points we have to look at to be able to answer this question. I mean, that's the question, like, is the oil supply will be able to match the oil demand? It will depend of the oil demand and first on the oil demand, and then if the oil supply is able to follow given the current pace of the investment that Pierre has told you. But I think we will touch on that in the second part as well. And we don't have, I think we don't have the pretension to know that. I think what we can give the best is all the different points that can impact the supply and the demand, and then
maybe I can point out that in the very short term, it's probably not a risk because there is a lot of stocks that have been made during the crisis, and there is a lot of supply capabilities from the, for example, from the OPEC. So next year or in 2 years, probably we are okay. The questions start to rise when we come into the midterm, like 2025, around 2025, 2030 for us.
Okay, so thank you for answering the question, which was from Adrian Wilbur. The next question from Neil McNaughton: How do the different levels of investment in oil, coal, renewables compare in terms of rentabilité? Like how many kilowatt-hour capacity can be bought per dollar for each energy source? Quite complex question. I leave it to you.
Okay, I can take.
You can take this one, Marine. Okay.
Oh, just to say that I don't have the number, but I think it's possible to calculate that regarding the fact that we know the price of the renewables and the oil, but what is sure is that for the industry, the oil and gas is still more returns than the renewables at the moment. And for the same dollar, you will get way more energy from oil and gas than in the renewables if you just want to spend $1. And we can do the calculation to have that. It's a good question actually, because it's a good point of comparison between the renewables and the oil and gas.
So another question where they ask you to forecast the future. How is from Richard Akbara, how is the outcome of the 2020 US elections expected to affect the global politics of price, demand, and supply of crude oil in 2021 post-COVID?
We'll touch on that a bit after, so I probably don't take that now, but maybe you can ask again the question after if you're not satisfied with our points. Yeah.
So there was a suggestion about the showing the statistics on US horizontal wells splitted per basin. I don't know if you want to comment on that.
So we could have done that, but because we didn't have too much time to dig into the details here, we have decided to focus more on the global picture, because we are looking at the global oil supply and not just only how it's going to evolve in the US. So, but I don't know if you have specific questions regarding the different basins, but yeah, we have done it on purpose to just show like the global the US as one.
I think the data is available.
Yeah, you can easily find the data sources. Yeah.
There is another question from Neil. Are there any really proven unconventional oil plays outside the USA?
You can take that one, mine. Yes, there are a lot actually. So you have a lot of unconventional potential in China. You have, of course, in Argentina with the Vaca Muerta. You have from there to there some interesting spots. But you have also to keep in mind, like for example, like the Permian Basin, it's really like a flat area with nothing on it, so it's really easy to come and put 20 trucks and drill holes. But if you go in China, for example, it's close to mountains. You have a lot of urban density, so it's very complicated to reproduce the same thing as in the US. And for example, in Argentina, you have a lot of potential, but you are really far from the first point of consumption. So you have to build pipelines, you have to build infrastructures, you have to basically bring people where is the oil. It's a bit remote. So there are a lot of reserves, but they are not necessarily as easy to access as in the US.
Okay, a couple of more, still a few comments from Jean-Jacques Biteau. US basins and plays are very different. The best outside the US, yeah, is Argentina and Neuquén with facilities. And about the US Unconventional, do not forget the geological settings. Okay, then we have a few questions concerning, I think related to the jobs situation you were mentioning. So from Ali, as professionals, should we leave this industry until the late 2020s? Or from Ade Parazi, Bobo, what's going to happen by the latest 2020s? Okay, so what do you have any?
Thank you. Take that one, mine.
I don't know. You can take it if you want.
Okay. I mean, it's really hard to predict the future.
I will just touch a bit this point of the shortage of talent in the next part, but complicated to answer that.
Yeah, but basically, you have two scenarios. We will talk about that a bit later. But basically, if the demand pick up, there is probably a future in the oil industry. But if the demand doesn't pick up, then it's a much more uncertain question to answer. But we can mention that in all the scenarios that we see so far, there is a need for oil, even in 2050, in the most sustainable scenario, because some of its usage cannot be replaced actually. So probably there will be some jobs to the extent that what it was before. It's really hard to say, to be honest.
So I suggest that we keep going, if you don't mind, and then we will take more questions afterwards. Thank you.
Thank you, Lucia. Yeah.
So, okay, so let's move to the second part, and I hope that you will have some answers to your question also in this part, or more discussion after that. So two other important factors regarding the oil and gas upstream industry that it will have to deal with in the future, it's the geopolitics as in the past and the climate change. So the next slide, actually, it's a good transition with the questions, because I just wanted to use the US election to illustrate a bit how politics could have a significant impact on the oil and demand supply. So the oil industry is very important in the US. It's a lot of different jobs, and it has always been at the heart of the US strategy, the oil independency. So Trump was really in favor of the oil and gas industry. So what could change with Biden? So first, when we look at the different announcements of Biden, you know that he said that it could have some cessation of new drilling permits on federal lands, and also it could increase environmental regulations. So that could increase the production cost of some producers in the US, or make more difficult to find some lands. But as the Senate is not elected before January, and it could stay Republican, I guess the changes will not be very strong in the beginning. And Biden also announced that he would probably reverse the Paris Agreement, so we could see more commitment from the US towards net zero also in the future, impacting on the oil demand. But the consequences are not only for the US, but also more globally, because on the supply side, we could imagine that maybe Biden will a bit have a different foreign policy and lift the embargo on Iran or Venezuela oils. And on the demand side, maybe he could source the trade war with China also. So that's the kind of consequences that the Biden election could have in the short, near, long-term future. But what is sure is that the oil and gas industry, the geopolitics is really a prime concern for them, and it can be both a source of risk sometimes, and sometimes it's more a source of opportunities. It's depending. And if we jump to the next slide, Pierre. So here I put a map of the geopolitics picture I see, with the main impact, main events impacting the oil production, and consequently the global energy security. So those events sometimes can reduce the global production by a few million barrels a day, and in a very short period of time, so the market can be vulnerable. And the nature of those changes, disruptions, can be very different. So for example, if we look at Libya, last year, the production was almost completely stopped due to the civil war and the strategic blockages of oil infrastructures. So no, the situation is way better, but it's to illustrate this kind of, you can have the civil war. If you look to Venezuela, for example, it's mainly political unrest that have been lasting for many years now. And the country oil production today is the same that it was in 1945, whereas it's the country with the most important reserves in the world. So you see like how geopolitics can have a strong impact on the oil production. Now, if we move in the Middle East and we look in Iran, the same, the 2 last years, the production has completely collapsed. And that is because of the US sanctions after the withdrawal from the Iran nuclear deal. And this situation could change in the future with the election of Biden if there is a renegotiation with Iran. So some of those events are predictable because we know the situation is political, it's politically unstable, or it's lasting for many years in Venezuela or Libya, for example. But sometimes it's just completely unpredictable. For example, last year, we experienced the attack on the oil infrastructures in Saudi Arabia, and it was a diminution by 3 million barrels a day just instantly. So that's why it can be a really the market can be very vulnerable, and sometimes it's also the countries themselves that can play on the supply. So it can be, for example, when you have an agreement with the OPEC, but sometimes it's also unilateral decision from one of the actor. So big actors such as the Saudi Arabia or the Russia or the US. And a good example of that is at the beginning of the crisis when Saudi Arabia, they started to increase their production, whereas the demand was collapsing with the coronavirus. And so that led to an even greater drop in the oil prices. So maybe it was just a ratio of power between the two, or maybe it was to worsen the situation in the US with the shale that are not really resilient to oil prices. I don't really know, but what that illustrates, at least, is that the geopolitics, it's very important factor when we look at the oil security. And it's complicated because it's difficult to predict or control. So we can just monitor the situation, but not easy. And with the COVID-19, we cannot exclude that more countries could be at risk. And it's particularly the case for the oil producing countries. So if we move to the next slide, Pierre. Yeah, so here I put very dependent countries on oil. And so what is important to understand is that in those countries, the oil is produced by national oil companies. So it's not private companies. So when you have a drop in the oil prices, it's not impacting only the companies, but the whole country directly. And most of those countries are not diversified. So they are very, very dependent on the oil for their revenues. So if you look on the graph in the red box, actually, it's the countries where the oil is accounting for more than 60% of the exportation. So in Saudi Arabia, Nigeria, Iraq, etc. So those countries will experience a significant decrease in their revenues today, this year, sorry. And if you look at the situation already in those countries before the COVID-19, it's countries where most of the time you already have economic or social fragilities and also high levels of debt as a legacy of the previous crisis. So now they are facing this dual impact of the lower demand and the low prices. And so it risks to aggravate some vulnerabilities because when your revenue decrease, then you have less money to spend in the social spendings, such as the schools, the road, etc., etc. So could lead to more social and political unrest in some countries and play on the supply in the midterm. And if you look at the next slide, I would like to emphasize here the fact that when we talk about the break-even, often it's to say if it's profitable or not to produce a barrel. But for those countries, what is important, it's the fiscal break-even or the external break-even, as I put on the slide. So the external break-even is when the oil price allow you to match the value of your importations and exportation and to equilibrate your balance. So if you look at the graph here, all the countries with low oil prices, less than $50, they cannot equilibrate this balance. So yeah, they are really facing an increasingly uncertain future. And I think there is a big challenge in those countries to start building more resilience with a more diversified industry. Then if we move to the next slide, I will start talking about a different topic, but very, very important for the upstream oil and gas industry. So it's the growing push we have towards cleaner energy in the public debate and particularly in the Western countries. So you can see that through social activisms or the calls for policymakers to restrict new oil and gas development, etc. So sometimes can seem a bit anecdotic when you take those different elements separately, but it's still, I think, a signal that we should not underestimate in the oil and gas industry, and that could be a real change towards the industry in the future. And especially because with the COVID-19, we have seen a kind of accentuation of the sense of urgency to act regarding climate change. And if we listened at the executive director of the International Energy Agency at the beginning of the crisis, he told us that we have to put clean energy at the heart of stimulus plans to counter the coronavirus crisis. Because if we don't do that now, like it's very likely that we will not do it on time to meet the Paris Agreement. And when you look at the decrease in the emissions this year, it's minus 7%. So minus 7% of emission a year, it's basically the order of magnitude of what we need to see every year until 2050 to comply with the 2 degrees. So it's just completely huge, the impact that could be this decrease in emissions. So this year we have also seen a lot of governments announcing a new plan to be carbon neutral by 2050. So the European Union already last year, but Japan, South Korea, and China by 2060. So it's not clear yet how they can achieve that, but it's a very, very strong signal, I think. If we move to the next slide, yeah, here it's another consequence of the climate consideration, but also of the different crises we have experienced the last years. It's that the oil and gas industry is less and less attractive for young people, both because you have the competition for the engineers in other sectors like the tech firms, the new energies, etc. But also because, and especially in the Western countries, the new generations, they look more interested in career perspectives and meaningful job, if you look to the studies, than in competitive salaries. And so you have to put this potential shortage of talents, or at least the best talents, in the that is happening with the massive wave of people that are going to retire in the industry in the coming years. So there is a potential risk for some companies to not be able to maintain this balance between the skills, and that could play on their performance if they miss some capabilities. Moving to the next slide, and to touch about the investment, Pierre already talk a bit about, but with the climate change, it's likely that in the future, the countries, the investors, it's likely that the disinvestment in the upstream sector will not only be the result of the market price variations, but also just linked to the climate change and the increase of the use of some criteria, such as the environmental, social, governance criteria, that will lead some investor to remove some asset from their portfolio, starting with the more polluting ones, so coal, unconventionals, Arctic, etc. And it's estimated that it could be hundreds of billions of dollars moving out the fossil fuels industry in the next decade. And also another risk that I guess some companies have experienced in the US, it's the risk for stranded assets in the industry, because it can be stranded volumes or capital or value, and that is a risk in the mid and long term for all the companies. Then if we move to the next slide, so as Pierre told us, the industry has improved in the last years with a reduction in the cost, more efficiency, higher production, capital discipline, etc. But they still have experienced a strong devaluation with the COVID-19 pandemic. So even if at the end you can see recently some rebounds after the announcement of potential vaccines. And actually, what is interesting to look at, if you move to the next slide, Pierre, it's to compare the oil and gas companies with the new energy companies. So if you look at the oil and gas, Ørsted, but if you look at the oil and gas, you can see that the evolution is very flat, almost zero, whereas it has increased a lot even during the COVID-19 for Tesla or Ørsted. And one fun fact actually is that Ørsted, that is the most important offshore wind developer in the world, is producing with the offshore wind asset the equivalent of 100,000 barrels a day. And it has the same market value than BP, that is producing like more than 35 times more. So what does it mean? I think that means that investors trust more Ørsted to create value in the long term than BP. And I would say that the question is that is the oil and gas industry still need capital in investment then? And I think yes, because I mean, we don't have to forget that today oil and gas industry is still 65% of the energy supply in the world. So most of the energy is fossil fuels. And even in the more stringent scenario, we need oil and gas in the future. And also because I think the oil and gas companies are well positioned to invest in low carbon solution. I mean, if you look at the potential in terms of investment, or also the expertise in managing a large project, the offshore capabilities, etc., I think they could be well positioned to go into CCUS, offshore wind, geothermal, or biofuels, for example. So the dilemma today for the oil and gas companies is to find this balance between producing oil and gas, returning value to the shareholders, but at the same time, they have to show that they are part of the future. They are able to build a net zero industry and to invest in low carbon solutions. And if you move to the next slide, Pierre, so you can see that recently a lot of oil and gas companies, the majors, and especially the European ones, have announced to be neutral by 2050. So Total, BP, Equinor, Repsol, etc. And they have quite high ambitions regarding renewables. But if you look at the graph on the right, like if we have a look at the last decade, the total expenditure in the low carbon solutions for the major is less than 4% of the total capex. And if you look at the NOC, it's even less. So it's probably still a lot of room for diversification in the oil and gas companies to answer the current challenges. Yeah, so now if we move to the last part of this conference, we'd like to give some perspective on the demand side, because it's an important factor that will drive the supply, of course. And if we don't have more demand in the future, so we don't have to worry so much about the supply as we're doing tonight. So just to remind you, the energy demand on the next slide, Pierre, has collapsed not only in oil, but also coal, gas, nuclear. It's only the renewables that have continued to increase this year. And if you move to the next slide, I think the two main factors that could impact the oil demand in the short term is the various containment. So are we going to experience new waves, new lockdowns? Are the borders going to open or not? Or are we going to find efficient vaccines? And also the economic response from the different governments. So today the question for the government, it's will they go for a rapid recovery of economic growth, no matter what it takes, or at the opposite, they will constrain the economic recovery with some climate consideration. And it's important to remember that the oil is 60% of the oil is in the transport today. So it's also a reason why it was so impacted by the current crisis with all the lockdowns and etc. And why, for example, the electricity sector was less impacted with the renewables. So if we move to the, here, it's complicated to forecast the oil demand because the situation is very dynamic. So we can only give some factors that we have to look at and then look in the different institutions, what they are telling to us. And for example, if you look at the International Energy Agency, what they see is that the oil demand is likely to return to pre-crisis levels between 2023 and 2025. So yeah, it's a strong effect on the global oil demand levels, this crisis. And if we move to this slide, so here we would like to highlight that if you look a bit in the longer term, two important things we should look at and could have a strong impact on the oil demand is the carbon neutrality that have been announced by a lot of countries, but also companies this year and in the previous years. So now the question is, what is the ability to implement that and how fast and how far? And if we have a less Western vision and we look at all the developing countries, it's also very important because if you look at the demand growth in oil during the two last decades, it was actually only from the developing countries and especially from Asia. So we have to look at the demography, the economic growth in those countries. And that is a bit illustrated on the next slide. Here, what I put, it's really to keep that in mind, but then the energy consumption have always increased in the past. And if you look at the renewables recently, they have not arrived in substitution of the fossil fuels, but only in additions. So I think it's important point. And if you look on the graph on the right, like it's the projected population by the end of the century, and we are still expecting a lot of growth, like almost 10 billion in 2100. So that means that the world will consume more energy in the future. But if oil is the more consumed energy today, if we move to the next slide, it may not be the case in the future. So many players are doing this kind of exercise to try to forecast what could be the oil demand and supply in the future. And it looks that there is kind of emerging consensus on a potential peak oil demand in the next decade, or at least with a flat growth in the oil demand in the future. Some people already think that we have passed the peak oil demand last year. I will not be so sure about that, because if you look at China, for example, they have already recovered the oil consumption they have before the COVID-19. So I think it's really important to look in the next decade to Asia and all the developing countries, maybe Africa in the longer term, because probably the oil demand will come from there again. And I think a last point we should look at if we have a very shortfall in the oil and gas investment, is that could open a door in those developing countries towards more coal. And that is really a big issue that we should not underestimate it neither. So now I will give back the floor to Pierre to conclude on this session.
Thank you, Marine. So a quick conclusion before to take the questions. Okay. So we wanted to give you 10 takeaways from this presentation. So the first one is that, in our view, this is the crisis. This is the most important crisis since a century for the oil and gas industry, and it has probably no precedent in terms of speed, impact, and consequences. The US have been particularly affected due to their already fragile state after the unconventional boom, and we have to expect more bankruptcies and consolidation in the coming years. For the first time in history, I didn't mention that earlier, but for the first time in history, the investment levels in oil and gas are to be outpaced by renewables, and this is a really historic in a way, and it represents a bit the paradigm in which we are today, is that this oil and gas that we are consuming, 65% of our energy today, is being less invested than renewables that represent 1 or 2 or 3% of the electricity produced at the moment, or the energy produced at the moment. The exploration is struggling to find new fields, and the replacement rate is lower than 10% for the conventional plays. It is very unlikely to see a boom equivalent to the US globally for unconventionals. Large investment will be required to compensate the decline rate, even in a quick transition context, in our views. And the international oil companies are particularly affected, and they have no other choices than diversifying their business model to follow investors, societal and climate concerns, and be able to attract talent and capital. So when it comes to the demand, the uncertainties are really high. It could be a quick recovery, or it could never come back to previous levels, and we could have reached peak demand. But as I mentioned, ASEAN countries will be the key actors to watch, and China has already reached our pre-COVID-19 levels of consumption. So really uncertain about what will be the future, but very interesting. Also, we will experience a global recession that will affect stability around the world and could trigger new conflicts that could have unforeseen effects on supply security, and countries largely depending on oil are the most at risk in our views. So to wrap it up, for us, the COVID demand shock has been a global catalyst. It has accelerated trends that will potentially put at risk equilibrium between supply and demand in the short and medium term. Today's investments are closer to sustainable demand scenarios from the International Energy Agency. And if demand recovers to pre-COVID levels, the risk of a supply crunch is really far from nil, and it could have devastating impact on the economic recovery and the world stability. So thank you for your attention. We are now ready to take all your questions, and yeah, thank you.
So thanks again, Marine and Pierre. You have a lot of congratulations for this brilliant presentation. So I think some of the questions there have been answered during your presentations. I will do my best to pick the ones which have not been answered. For instance, there is one about about Algeria. Why is Algeria is not on the oil and gas dependency graph? I don't know if who can take that.
I think it was actually.
It was?
Yeah.
Can you please, because I'm sorry.
No problem. Okay, it was not there, sorry, but it's mentioned here.
Yeah, though it's because this graph, I took this graph from the OECD, so it's why it's not there, but it could be there, yeah. I don't know, I don't have exactly in mind what is the contribution of oil in the export in Algeria, but I think it's a lot because it's the first one on the external break-even.
Okay, thank you for this. Then interesting question. Richard Akbara, is it possible for the international oil companies to achieve carbon neutrality without carbon capture?
You want to take that one, man?
The companies then?
International companies.
Yeah, I think, I mean, they have announced being carbon neutral by 2050. I think you have many ways to achieve that, and more or less good ways. You can reduce your oil production, or you can capture your emissions. You can do CCS. You can also pay for carbon things like investing in forest, etc. So I guess you can do without, but it's still for. If you look at the fact that the companies, they want to continue to create value, maybe developing CCUS solutions for the oil and gas industry, it's not the worst way to do that.
Okay, so somebody asks, what is meant by Total's smart energy investment? Why none of the other international oil companies? Neil asked that.
Sorry, can you repeat the question, Michelle?
What is meant by Total's smart energy investment? Total, and why none of the other international oil companies?
In this graph, I think it's because here it's represented from the past decade. So maybe if we had a graph over the years, it will be different. Probably because Total started earlier with.
Oh, I think Pierre, the question is just on the graph, like the gray part that is energy smart technologies. No, you are on the right slide.
Okay.
It's just the gray part. What is the energy smart technologies that Total has invested in? I don't want to say something wrong, but I guess it's a lot in maybe in the energy storage, or like all those investments, like they have invested in the batteries, etc. And as it's not capturing the wind, hydro, bioenergy, CCUS, I guess the smart technologies is including all of that. But we have all the sources of the graph here on the document, so it's easy to go and check exactly.
Okay, so do we have a graph that links global? Oh, sorry, because I keep receiving questions on the chat, and that links global oil supplies with GDP growth in our Western economies for the future. Do we have a graph that links global oil supply with GDP growth in our Western economies for the future?
We have that for the past, but certainly not for the future. I mean, you can do some estimation, but yeah, it's expected that you don't have the strong correlation between the oil supply use and the economic growth, especially if we go towards more electrification, especially in the developed countries and in Europe. So definitely a link that is less strong than in the developing countries.
Okay, I think I don't see. I think most of the other questions were already answered. Do you think that the peak of the demand was reached in April 2020? And I think you covered that well enough in the presentation. And I don't know if there are other questions, maybe which I haven't taken. Thank you for the wonderful presentation, Pierre and Marine. We have another question. My question is, in the light of Western shift away from fossil fuels, what will be the way forward for national oil companies of countries who are largely oil dependent?
And maybe start on this one, Marine, if you want.
Yeah, I think it's very completely different, the oil, the NOC and the international oil companies that are private and the national oil companies, because you don't have the same investors in a sense. So I think on the NOC you have less pressure to move towards green energies. I think it's more a strategy from the governments themselves to diversify their industry and not go more only for oil. But it's likely that in the future we observe the IOC diversified more towards more green energy, and the NOC will probably just stay oil producers. And I expect if the countries they want to diversify, it may be not the NOC that will go to produce the renewables, but they will set a different company, I guess.
Okay, I think we have maybe one other question, if I can catch it again. Well, we have a question about also the how the crisis impact the geoscience jobs for the near and long term, geology and geophysics, etc.
So we'll take that one. But so I entered the industry in 2016 and graduated from my school. So can definitely tell that it will affect the geoscience perspective for jobs. In most of the IOC, we have seen a switch in strategy recently when it comes to exploration. Most of the company will now focus on prolific basins. What they call prolific basins is basins where they have already discovered fields and where they already have infrastructures where they can find smaller volumes. But overall, I think it's always the same thing. Like, if tomorrow the oil prices recover to a new height because we have a supply crunch and that there is a need for new investments, there will probably be a need for a lot of new geoscientists, and there will be a lot of new jobs and a lot of perspectives. If the demand remain low, probably that we will see not less jobs, but yeah, at least the same level of jobs, or it's really hard to say. And as mentioned by Marine, there is also this problem of this wave of retirement, because you have all this generation that started at work in the industry in the 70s, the 80s, that is having most of the jobs today, that will retire in the next 5 years. So you will have this massive gap of skills that will be created over the years, and plus the fact that most of the companies haven't hired people by wave during the different crises. And if you remember, you have the crisis in 2008, in 2014, and now a new crisis. So there has been a successive wave of not recruiting people, and it might create a gap in talent and probably a need for geoscientists at some point also.
Okay, maybe before closing, the last question from Maxence Cordiez. Is the problem with oil in Venezuela only due to political unrest, or is there also reserve aspect? And there was also a comment that the reserves in Venezuela, that was from Jean-Jacques Biteau, are only given by the government. They are not certified by the SEC. Okay. So, you want to answer this question about Venezuela?
I guess in Venezuela, it's as it's EV oil, it's kind of an expensive oil to extract, and also that will need very skilled people to do that, because it's more complicated to to produce this oil than a conventional one. And actually, so maybe for that in Venezuela at the moment, I think they don't even have the right people to produce this kind of oil, even if we have the reserves.
You really had all the engineers in oil and gas in Venezuela left the countries in the last years, so you can find a lot of good Venezuelan engineers in the industry around the world. So yeah, it's probably also linked to the fact that they have less capacity to invest today.
Okay, sorry to, I think we have to interrupt now this very interesting discussion. I just wanted to make a few comments concerning the webinar tonight and the activities at the EAGE Local Chapter in Paris, because interesting things came out about the skills of the geoscientists. As you know, we have already organized some afterwards, and we're still active about this theme. We are going to prepare also an event and after work in 2021 about carbon capture and storage. And of course, when you mentioned all the business models, the new business models, maybe I can put also my video, all the business models of the international oil companies. I just want to remember the Get20 conference, which was held by the EAGE just last week, where there were a lot of interesting presentation on carbon captures and geothermal and energy storage and so on. So thank you once again for your brilliant presentation, and we will keep in touch for sure with the local chapter. Thanks.
Thank you, everyone.
Thank you very much.
Nawal, maybe if you want to give bye-bye to everybody. Nawal?
Yeah, thank you, Marine. Thank you, Pierre. We can see in the chat that everyone is very, very happy, and so the presentation was great. Thank you.
Thank you for the great questions, everyone. Really interesting discussion.
Yeah.